All right, good morning, everybody. Happy Monday. Today is Monday, February 27th. Hopefully, y'all are having a good Monday so far, and hopefully, y'all had a great weekend. So, what's sending us up in the markets today was the durable goods order, which I expected to be non volatile, but it seems like a lot of people are paying attention to it since it came in pretty different than what was expected. So, if we go over to the economic calendar, and look at the durable goods, this came in at positive 0.7 for the core versus 0.1 expected. So this was higher than expectations versus previously negative 0.4. So the core was up. And then if we look at regular durable goods, this was actually down negative 4.5% versus negative 4%. And this is from positive 5.1 last month, or I guess in December. So, what this could possibly be signaling is a slowdown in demand just for the regular durable goods. For core, it does seem to be still going up. And then excluding defense, this was down 5.1% versus positive 5.6% as of the latest report. And then you have X Air, so that's just excluding what is it? Just like orders for like airplanes, like from Boeing and shit. Positive 0.8 versus negative 0.3 as of the last month. So I guess there was a significant difference between the durable goods order at negative 4.5 versus negative 4.0 expected. So that's probably going to be the headline number that you're seeing today. And what I was seeing for the headline there was durable goods order month over month, negative 4.5 versus negative 0.4 expected. So I guess the headline here was a fat finger typo. It should say negative 4.0 instead of negative 0.4. So I wonder if that will be probably revised, that headline. That's what kind of shocked me whenever I saw that on Thinkorswim this morning. But seeing that it's negative 4.0 versus negative 4.5 actual, that's less significant. But let's see what else we got going on. SPY is basically trading at that 400 level. It's up by about three quarters of a percent so far. I did open an iron condor last thing on Friday that we'll check out. Assuming that SPY will be between $391. So I opened this in two legs, put credit spread and the call credit spread. Assuming SPY will be between $391 and $399. So we are testing that $399, the call side. But we'll see how the markets react on open. See if they end up pulling back. I would imagine that RSI is probably pretty hot. Around 70 if I had to guess. Let me see if I can load my RSI MACD studies. Yeah, 68 on the RSI. Not too shocking there. And we're starting right at that 400 level. Let's run a poll to see who thinks that SPY will stay above 400 for today. Will SPY close SPY will close above 400 or below 400. So let's ask the community, see what y'all think we're going to land today. All right. Right now we're trading at 399.75. The call credit spread that I had opened is currently down by $150 at the moment. The max loss for this would be 500 minus the credit received, which was a total of 25 times 5, 125. So max loss of 375 if this does end up continuing to push up above 400. I think these are a little bit pricey at 58 cents. They should be. I guess they're priced about right at 55. I would think that they would be trading more like 50 cents, but um, it is early in the morning, and the earlier it is, usually the more value that these contracts are going to have. So we'll keep watch. Good morning, Nice Fishman. Good morning, Prosper, Andreas. Good morning, Irfan. Welcome again. All right, looks like my UVixie calls have basically lost all their value at this point. They're only trading for 6 cents a piece. When I originally sold them for 21 cents a credit, so I've made $30 on trading this UVixie covered call. UVixie's down like 3.5% today. Not too shocking there. Let's check the fundamentals of the market. So the VIX is down 1.3%, trading at 21.39. 10-year is still above 3.9, but on the low end of that. And where it was pre-market on Friday. So if we see this starting to rise back up closer to 4, that would be bearish for the market. And then the dollar index also pulling back, peaking at actually 105.36 in the morning, and now it's trading at 104.84. And then the last thing that I like to check on the fundamental side is the FOMC watch tool. See what the odds of 25 or 50 basis points is, and then where the peak rate is estimated at. So the odds for 50 basis points actually came down from 27% as of Friday to 22%. So after this core durable coming in negative at 4.5%, that is showing slowing signs of demand, which is pulling back the odds of 50 basis points for the March meeting. But if we go out to, say, July, we're still expected to be at 525 to 550 for the peak rate. I'm assuming this is the peak. It might be. No, that is the peak rate expected in July. And then if you look at the odds of going to 550 to 575 for the peak rate, this actually dropped from Friday from 32% to 29%. So fundamentals are looking pretty bullish. Markets are up good 0.8%. So I do think that we're probably going to hold up. I'm just not so certain on going above the 400 level. I think there's probably going to be a good bit of selling pressure at the 400. So far, the poll is saying that 69%, nice, 69% of people are assuming that SPY is going to be below 400 today. And right now we're trading at 399.38, so we are pulling back a little bit on this first candle. Good morning, Peter. Watch the RSI here. So if this goes below 50, that would be negative for the market. We will turn bearish. But right now we're trading at 54, so if we do end up catching a bounce, that would mean that we remain bullish for today. Good morning, Stash Gang. Oh, I miss my mustache. Can't grow the stash back until we're back in the bull market, though. Good morning, Mike. There's no real news that's coming out. Let me check FinTalk. Again, I hate the name of the app, but that is what it's called. They have news on pretty much every stock that you can think of. And on the macro, it's not TikTok. It's not the financial side of TikTok. It's an app that's literally called FinTalk, FINTOK. Unfortunate naming, but really good place to find your news. Pound rises to session high at 120.3 after UK and EU reach a deal. So that's why you're seeing the dollar trading down today, because of foreign exchange. U.S. stocks extend the gains, with the NASDAQ up 1.06%. Given that treasury rates are pulling back today, that's not too surprising. Let's see. Burns says important to maintain bipartisan approach in dealing with difficult government in China. U.S. ambassadors to China, Nicholas Burns, says U.S. must push China to be more honest about COVID origins in Wuhan. Brexit, an agreement has been reached. The deal has been done, according to BBC reporter. Snapchat says beginning to roll out AI to Snapchat Plus subscribers. Oh, they have Snapchat Plus now. That's interesting. I didn't even know they had a subscription service. U.S. stock index futures are at session highs. 10-year Treasury notes. 2-year declined slightly after the durable goods data. Yeah, that's exactly what we talked about earlier this morning, and that's pretty much all the important news as of this morning. And then the durable goods, of course, that came out at 8:30. Ah, interesting. So Apple. So some ticker specific news. AAPL. Production has been halted at the Foxlink facility due to a fire incident, according to police officials. So, not really affecting Apple too much. But that news came out about 8:15 this morning. And they just kind of rallied with the rest of the market after the core durable goods in the durable goods order. So that might actually be a decent short position if that news becomes more apparent, but doesn't seem like many people are following that news. Again, it came out at 8:15. You're seeing some news reporters at 8:22, production halted at Apple supplier Foxlink due to the fire incident, but not really much movement on it other than just trading with the rest of the market. All right, SPY is just kind of chilling. Is FinTalk on Apple only? I'm not sure about that. Let me see. FinTalk for Google Play Store. No, they have TikTok. This might be it. Maybe. Instant messaging, groups, video calls, real-time complete chat. That's not what FinTalk is. Yeah, it might just be on the App Store. FinTalk. Stock app. No. Yeah. I'm only seeing it on the App Store. I'm not seeing it on the Google Play Store, unfortunately. Let's check the VIX is down 21.14. So the VIX has actually fallen a bit more. Fundamentally, that would send the markets up. 10-year still holding at 3.9. And then the Dixie, the dollar index, is still holding. So if we see a reversal for the dollar index and the 10-year, if we see those going up early this morning, then we should see a pullback for SPY, but not really seeing that as of just yet. And then still holding above 50 on the RSI. So still bullish momentum until we go below it. Thought on having a put credit spread for Tesla with the March 1st event. Buy today and sell out tomorrow before the event. For not taking any chances on it. Usually, whenever Tesla has an event, they sell off pretty wickedly. So if I were to trade around their March 1st event, I would probably just trade a bearish. Don't put a lot of money on it, obviously, just in case they do some sort of crazy ass announcement that ends up sending their stock up 10%, like we saw for Nvidia after the earnings. But I would say probably good chance that they're going to stay below recent highs. So like 215 might be a decent place to take a short position. 220. Right now it's trading at 205, so it's not really much of an expected move for a stock like Tesla, especially around a big event like that. And you said March 1st, so you still have good, today's the 27th, 8th, and then one more day, so that would be 3 days until expiration, or 3 days until the event, and then you could set the expiration date for what is the next Friday expiration? I think it's the 2nd, if I remember right, but let me double check. March 3rd, actually. Yeah, so if you take a call credit spread, assuming that it won't go above the new highs, or the recent highs, I should say, 215 strike price, you get paid 65 credit for 250 wide, so you're risking 185 to make about 70. Well, that's based on the wide bid-ask spread of Robinhood. Well, it's actually pretty accurate. So your risk-reward ratio is about 3 to 1. I would prefer it to be a little bit lower, like 2 to 1 on an event like that. So you could always lower your strike price down. But then, of course, you do take on the risk of the stock rising above your strike price. So kind of trying to find a balance between that. Even if you go with a March 10th expiration, you're still getting only 70 credit. So that's really not worth it, in my opinion. And it's trading at 205. That's only 10 points above where it's at right now. So 10 over 205 would be a 4.5%, 5% rally. Interesting that it's not paying more for that March 1st event. So you could wait for it. Yeah, it's investor day for Tesla. People are speculating on a whole bunch of different things. Might release the I would be most interested in the what is it called? The master plan part 3 or part 3, whatever you want to call it. That's what I would be most interested in seeing. What is the long-term outlook of Tesla, especially given the new purchase with Elon buying Twitter? How does that play into, the whole vision for Tesla? I think it's pretty obvious why he did end up buying Twitter, especially given his jadedness, I guess, against mainstream media, and how mainstream media continues to perpetuate how Teslas are so bad and they just keep catching fire, and there's this problem with Teslas, there's that problem with Teslas, and basically no news on other electric vehicles or other cars catching fire. So I think that it was pretty obvious why he bought it, and now he's trying to make Twitter the go-to place for getting news. So I think that could be beneficial to him in the long term. But I think there's still a lot of people that are just going to listen to mainstream media just because they've listened to mainstream media all their life. So but yeah, SPYs ended up pulling back down to 399.17, so we might just be at 50 RSI. Might start trading bearish, currently at 48. So if we get a decent sell here, We might be bearish for the next, I don't know, probably 30 minutes, hour. Short-term time frame. Call credit spread that I opened is now only down by, let's see, 117 versus 150 earlier. They're trading for 48 cents a piece. They should be going for like 45. 40 to 45, but they're not, just because you have so much time until expiration date, or expiration at 4 p.m. We might be still above 50 RSI. Just trading at a very, very small range this morning. A very boring day. I think it's easy to say that we'll stay below 404 today, though. We might be able to get a decent price for that. Possibly. Let's see, 404. Call credit spread. You're getting paid. You're only getting paid 4 cents for a dollar wide. Not even close to being worth it. And then if you extend your expiration date, let's see what's on the economic calendar. What could send us down from where we're trading right now. Economic calendar. Hi from Korea. Mr. Worldwide. Hello, Dennis. Okay, so if we're looking at this week's data, we got a Fed member speaking in about 40 minutes. I wonder what they're going to say. So Fed Governor Jefferson speaking at, I guess, 10:30. Not 100% sure what time that would be. Around 10:30, though. And then you got goods trade balance tomorrow. Not really a main event. You have retail inventories. That's going to be the main event tomorrow. That could send us one direction or another. So the way that you interpret retail inventories, if retail inventories are higher, in order for retailers to get all the excess off of their shelves, they have to lower their prices. So that would be disinflationary. Whereas if retail inventories comes in higher, if it comes in lower, if it's negative, that means that they have less on their shelves. That means they can raise prices, so they can add more to the shelves. So it's all about kind of supply and demand. This is more about the supply side. And whenever supply is rising, prices will go down. Whenever supply is declining, prices will go up. You got wholesale inventories, housing price index, not really relevant as of right now. Wednesday, you have manufacturing PMI, purchasing managers index. So that's also kind of a proxy for the supply chains. How many goods are being produced, or how many are expected to be produced over the next year. If this comes in above 50 or above expectations at 47.8, that means that there's more goods expected to be produced, which would be disinflationary, positive for the market. If there's less, if this number comes in worse than expectations, there's less goods predicted to be produced, which would be inflationary, bad for the market. So that's the big events for the first half of the week. I think we might trade the wholesale, or not the wholesale, but the retail inventories that's coming out tomorrow. Last month it came in at positive 0.4. There's no expectations set for it. Quite unfortunate, but based on the durable goods, this might come in negative. Markets could be positive tomorrow. I just find it hard to believe that we're going to go above the risk range at the beginning of the week. It could happen. And maybe we see above like 401, which is above where we're trading right now, obviously at 399.50. I might reserve this trade for the end of the day rather than opening it right now, but let's see. So if it's above where we're trading right now, that would be a called debit spread that we would want to open. And that right now for tomorrow's expiration date is going for, let's see, that is not the right, there we go. It's going for 45 cents. I'd try to get it for lower, like 40 cents. Maybe if we trade down a little bit lower than we're at right now at 399.50, if we go down to say 398 or maybe even the 397 price level, might be a better deal than what we're getting today. Hat day. Yeah, it's a bad hair day for me, so decided to wear a hat. You're welcome, Dennis. Afraid of a Tesla call credit spread as I got burned for earnings. Covered call, strike price 145 and it ran to 210. Yeah, Tesla's a hard one to trade for sure. It's a very volatile stock in both directions, so if you guess the wrong direction, then you will end up losing a good bit of money. Let's see. 10-year is still low. Dollar is still lower. The VIX is still lower. So I guess we might end up being bullish for today based on the fundamentals. So might just hedge with this call debit spread, assuming that we'll be above 401 with retail inventories coming in tomorrow. Right now you're paying about 50 cents a contract. It's kind of expensive, but let's see. I'll try to get it for a little bit cheaper at 48 cents a contract. If I'm lucky. If the Robinhood gods will allow me. Got a 50-50 split between above 400 and below 400 for the poll we're running right now. We're above 50 RSI though, so that is pointing bullish to me, and all of the fundamentals with VIX down, 10-year down, dollar down, all of that is screaming bullish to me right now. All right, just snag that call debit spread for tomorrow's expiration date. Swing trade. Well, hoping to be a swing trade. It might be a day trade if things get out of hand today. New options alert. Premium members just opened a new SPY call debit spread that expires tomorrow, which is the 28th, last day of the month. And I got them at 48 cents each. Didn't spend a lot on it. I never usually do with debit spreads, just because they're less likely to work out. And strike prices, I'm assuming that it's going to be above 401. Let's see, currently trading at 399.75. Can you see the 1-year chart for my Robinhood account? It's probably going to be down a lot just because I had really bad long-term investments. I was invested in Maps, like $12,000 into the stock, which obviously didn't perform well. It was trading at like 20 whenever I bought it. So I basically ported my whole portfolio into a SPAC stock, which was stupid. And then Fulgent Genetics was another major purchase of mine. Ended up buying this from like $90 to $140, and that's been declining ever since, down to $31. Still buying the stock. I think this one is a better opportunity. But yeah, keep that in mind when you see the 1-year graph. It's going to be horrible. Down by 41% just because of those two main investments. And then the options account, that's really where I've been kind of holding steady. If you look at the drive that I have, so I log all my trades here. So this is That's more of my long-term investments that you're seeing down by 40%, which, I mean, who isn't down a good 30% year over year? Especially investing into small caps. That was my main problem. But yeah, looking at this year, starting off the year down 755 for January, up 1100. Last year I made about 5,000 using 10,000 in investments for options. So my real edge is definitely not in long-term investing, but more so in options. So that's what I'm trying to focus on more. I sold out of a lot of my stocks in June of last year. I sold out of, I had, what was it, like 40 shares in Tesla. Now actually 70 shares in Tesla. I sold out in June down to just 30 shares. I have been picking up more Fulgent recently. I've been dollar cost averaging into this one. About $100 a week, sometimes $200 if Tesla is trading too high for my taste. I'll either buy $100 worth of Fulgent, $100 of Tesla, or I'll just buy $200 of Fulgent, and then I'm also buying QQQX. So this will be a income generator, which I think is probably the best way to invest as of right now. Probably not QQQX itself. You could also try JEPI, JP Morgan Equity Premium Income. Let's see how much they pay out. Does it say how much they pay out? I thought it was like 8% or something like that. So it's basically what QQQX does into paying out. But yeah, QQQX is a pretty decent one. But, you know, that is heavy on growth stocks, which are not doing great as of the last year. So let's check the call credit spread down 200. So we might have to get out of this now that we're above that 400 mark. All the fundamentals are screaming towards the upside, so gonna have to take the L here. Open 5 of these at 25. Now they're going for 64. Yeah, I think it's just best to get out while I have the 200 instead of taking the max loss, because that could end up being a max loss pretty easily. Hopefully I can get out at that price. There we go. Yeah, 66. So I got too little of a credit for that one, especially considering that it had the whole weekend to go up. But yeah, we're definitely rallying on that. Closing options alerts. Premium. Just cut losses on the 399 400s by call credit spread that expires today, 227 at 65 each, or 66 each. I originally picked those up for 92 and then 31. 92 plus 31, 123 over 5, 25 cents a piece. Originally opened at 25 credits, 5 at 25. So 66 minus 25, 41 times 5 is 205 for the loss, which partly made up by the put credit spread that I opened. That is not the put credit spread. That is the call debit spread that I just opened recently. And then the put credit spread, that one's basically at max profit at this point. I opened 5 at 13. So that'll make back a good $60 to reduce my loss on that to 140. Actually a little bit more, I guess 135. And then that SPY call debit spread for tomorrow's expiration is currently up by 9. Probably going to keep holding that for the retail sales tomorrow morning. Why not trade earnings? Sell puts on decent companies, gives good amount of IV. Close the position after the earnings to get the profit. I'd rather not take on the risk of owning 100 shares of any stock right now, unless it's, a staple stock. If it's a Coca-Cola, Walmart, one of those kind of value stocks will be best. But if you're doing that on, something like Snapchat, if you're doing it on something like even Tesla, probably not your best bet, just because of growth is going to get hit by the rising interest rates, costing companies more capital to service their debts. Whereas if you have established companies like Walmart that's making hundreds of billions of dollars a quarter versus a company that's only making tens of billions or even just like $1 or $2 billion a quarter, it's best to be in those more established companies during this time. But I do trade on earnings. I trade this week. I'm trading Zoom, which is reporting today after hours. Trading Costco, which is Thursday, and then trading Target, which I think is tomorrow pre-market, if I remember right. Target's already up, and I'm assuming that they're going to go up with our earnings. So that could be a lost opportunity that we have there. My assumption, let's see, go to my Notion page. Do I primarily trade spreads? Yes, I do. Yeah. Regular calls and puts, you have to deal with IV, or implied volatility, in the Vega, which will kind of screw around with you. You could do, regular calls and puts and just set your strike price based on your break even. But my preference is just spreads, just because they use the least amount of capital that you can get. What did I trade for Zoom? I haven't traded it yet. If we look at the expectations is 80-cent earnings per share. Last quarter they did 21 cents, 75 cents a year ago. Historically, over the last 8 quarters, they've done 84 cents. This has been declining in recent quarters, so if we assume that it's going to continue to decline, they're probably going to miss on their earnings per share. And then if we scroll down to my price targets for earnings beat or earnings miss, if they miss on their earnings but they meet on the revenue, they're probably going to stay above $71. If they miss on their earnings per share and if they miss on the revenue both, they're probably going to go below $70. And then if they end up beating on the earnings per share, beating on the revenue, probably going to be above 80. And then finally, beating earnings, missing revenue, above 77 would be my guess. Yeah, I mean, spread options are just more predictable than what you'll get out of a regular option. Like, what your max profit is, what your max loss is. It's very set in stone. I'd rather know my risk reward ratio than have, the infinite potential for upside for call options or put options too. But yeah, SPY definitely gapped up a good bit this morning. That's a fat gap. 397 at the highest point on Friday. Now it's trading at 400.7. So those call debit spreads that I got ought to be picking up in value a little bit. I'm watching that 401.44 mark. Yeah, for Zoom earnings, like I said, if they beat on earnings, let's see. If they beat on earnings, beat on revenue, the stock is going above 80 probably. If they beat on earnings, miss on revenue, probably be above 77 would be my guess. So those would be call debit spreads that you would use for that. And then if you're assuming that they're going to miss on their earnings per share, which I think that's a good possibility, they're probably going to stay above 71 if they beat on the revenue, or go below 70 if they miss on the revenue and their earnings. This is probably the most likely scenario, though, in my guess. So probably a put credit spread above 71 might be the best trade. Would I consider myself a low risk trader after years of investing? Yeah, I would say that I started pretty high risk. I was very much into just trading just regular calls, regular puts, didn't really have any kind of rhyme or reason to it. I would usually end up riding into max loss for the options, and then the ones that I would win on, the other 50% would like barely be like 10-15% profit. So definitely, been doing better. Over the last year was 50% profits for the options account, and then so far this year is up, using 7,000 to trade options with, and I've made a cumulative 400 or so. So 400 over 7,000, about 5% year to date. So it's been a little bit better as of recently, and I think that spreads is probably a large part to do with it, just because they're more predictable. Like I said, like what your max loss and max profit could be. You have a defined risk reward, which I feel like is probably the best. Let's see. It does take a while to get approved for level 3 options and spread options, though, so you might have to wait on that. All right. So assuming that Zoom will stay above 71 with the earnings beat and a revenue miss, opposite. Revenue, earnings miss, and then a revenue beat. For a put credit spread, assume that it'll be above 71, you're going to get paid 24 cents in credit. It's not exactly the best risk reward on that. But, okay, so you have a wide bid-ask spread. So that is in your favor there. So if we go to Aries instead of Robinhood, they'll give you a more accurate bid-ask spread that you can type on Robinhood too. But if you go to Zoom, their options chain expiring for this week, assuming that it's going to stay above 71, sell this, buy the 70, place the order, and these are going for 37 cents at the bid, which is what you'll sell them at if you want to get filled right away, and then 43 cents at the ask. So 37 I think I'd be okay with. And with earnings trades, I never usually trade with more than about $200 in risk, just because earnings are binary. It's very easy to be wrong on them. So looking at opening a few of these for $189 in risk for $100 of credit, $110 credit. There we go. All right, new options alert. And their earnings is going to be today after hours, so we'll know the results very quickly. Just opened a new Zoom put credit spread that expires, let's see, this Friday, which is the 3rd. And I picked them up at 0.37 each. Yeah, exactly. Like if it's a decent beat, like I said, if this is trading, if they have an earnings beat, if they have a revenue beat, then this is probably going to go above $80. So that would be easy to take profits there. If they have an earnings beat and then a revenue miss, this is probably going to head above that 77 level. So both of those scenarios, you'd be able to take profit. The only scenario where you would miss would be if they miss on both their earnings and their revenue. That would send it below 70. So that one you would take your max loss, but that's why you don't want to risk more than a couple $100. That's what I put down. All right. Let's check out the Robinhood, see how that call debit spread is treating us. Up $50 since we opened. Oh, that's the put credit spread. That's basically max profit. And then the call debit spread is actually trading at 56. Originally opened those at 48. Only opened a few of them, so haven't made a lot of money on this just yet. But we are pulling up to that 401 price level. So it does seem like we're going to stick with 400 today, above 400. And we are approaching that 401.44 mark. So if we are going to pivot for the market, that would be the line to look out for. The National Association of Realtors said on Monday its pending home sales index based on signed contracts jumped 8.1% for January, the largest increase since June of 2020. That's insane. That people are buying up homes at 6% interest rates with still elevated home prices. That's nasty, man. Can't believe that people can afford that shit. U.S. ambassador to China says U.S. agricultural relationship with China going quite well. Technology will be the heart of the battle. U.S. pending home sales came in a positive 8.1 versus 1.0 expected. Jesus Christ. Yeah, so there's a lot of demand for homes for January. Not really too shocking, though, given that interest rates did end up coming back down for the 30-year mortgage from like 7% to 6%. So that 1% drop in interest rates ended up triggering a lot of people to buy up more homes. That's what you call aggregate demand. Still a shit ton of liquidity in the market if that's the case. But the Fed is still asleep at the wheel when it comes to inflation. All right. QQQ is up the most at 1.4%. IWM is up 1.3%. Where's the Dow at? I haven't. Where is my Dow? Dow is up 1%, and TLT even is up 0.3%. So bonds are going up with a 10-year falling a bit. 10-year might be recovering now, 3.916, still at the lows. But does seem to be catching a little bit of a bid, at least at 3.9. So this might just end up trading in that 3.9 to like 3.98 level for a good while until the next kind of major event, I guess. Yeah, it's just been trading in that. It did dip slightly below it on Thursday, it looks like, but then it ended up recovering back. But it's been in this range ever since the 17th. So 1, 2, 3, 4. This would be the 5th trading day that it's been in that price range. And then the dollar, on the other hand, dollar is still sinking. But the dollar has been rising over the last 6 trading days, whereas the 10-year has been flat. I want to check in on that. I don't think that housing data has much impact on the market, but I just wanted to check in on. Yeah, it came in at positive 8.1% versus 1% expected, and up from 1.1% in December. That's ridiculous. But yeah, markets usually turn a blind eye to housing data. As of recently, at least. That could change in the future. But right now, markets don't really care about housing data. All right. A 400 401 call debit spread. There's trading for 60 almost, 59 cents a piece. Kind of wish I went heavier, but I don't really like to spend too much with these call debit spreads. I guess I'll just have to keep on holding with no big news coming out between today and tomorrow. You do have the Fed member, the Fed governor, which could maybe change sentiment. They're speaking at Fed Jefferson is speaking in 10 minutes, so at 10:30 that might shift the market in one direction or the next, depending on if they come in saying 25 basis points or 50 basis points, especially that'll trigger the market in one direction or the other. 25 would be bullish, and then 50 would be bearish. And yeah, not really much else coming out until probably end of week. I mean, you have some data like retail X inventories or retail inventories X auto tomorrow. I feel like that should have 3 stars instead of 2 stars for implied volatility, but everybody has their idea. And then consumer confidence, that might actually be pretty volatile tomorrow too. That was very volatile last week, or the last time that it came out. So definitely be looking for consumer confidence at 10 a.m. tomorrow. And then towards the end of the week, I think the main event is going to be services PMI. That's what really triggered us down last week. So if that ends up correcting to being worse than expectations, well, I guess there's no expectations, but if it's worse than it was at the last reading at 50.5, if it's lower than that, that would be bullish for the market. Above 50.5 would be bearish. Yeah, I mean, that's the ideal scenario, but right now you're bullish on technical analysis with above 50 RSI. You're bullish with the VIX down. You're bullish with the 10-year trading closer to 3.9 and the dollar continuing to sink. So I would not want to take any neutral positions as of right now, unless you're going closer to the end of the week. Then you might get some consolidation depending on how the reports shake out this week. Still wondering if we can make a trade on target earnings. So going back to my analysis notes for target at the bottom of this page. I think that they're going to beat on earnings. Probably going to beat on revenue. So for that case, target would go above 173. Currently it's trading at 169. And then if they miss on revenue but beat on earnings, they're going to trade above 168. Already doing that right now. If they end up missing on the revenue or missing on the earnings, beating revenue, they would be above 164. And then if they miss on both, that would be below 158. I feel like, let's see. If we can get a decent credit above 164, I might take that trade. But, you know, the higher the strike price that you go with, the better the risk-reward ratio you're going to get out of it. So if you're assuming best case scenario, beat earnings, beat revenue, this is the best trade to take on for risk-reward. $70.71. All right. But yeah, if you assume target's going to go above 173 for their earnings, which is going to be reported tomorrow in the pre-market, with this being a call debit spread, I would risk less than I would usually do with a credit spread. You're going to pay, let's see, they have the 172.5 strike price instead of 173, but you're paying, man, I keep selecting the wrong ones. There we go. 140 in order to make 110. It's a bit much. Oh, the bid ask is 40 cents wide, so you might be able to get that at like 125 or so. So you get a 1-to-1 risk-reward ratio for that trade. What do we get if we get, if we sell 167.5 and buy the 165? That one you're getting paid 95 cents minimum credit. That's actually a better trade in my opinion than what you get for the call debit spread. You get about the same risk reward ratio. You're spending like $10 less, and the stock can either trade flat or go up, whereas with the call debit spread, it has to go up for you to make profit. So going back to each scenario, this would assume that they beat earnings, miss revenue. If they miss revenue, beat earnings, it's going to stay above 164. Let's see what that pays us. Can't imagine a lot, but always good to check. That one's paying 80 cents at the bid, 105 at the ask, so you probably get about 90 cents. You risk an extra $20. I think I'm down for the 167.5, 165. If it's going to pay me what they're saying that is. Yeah, that one might not pay me what I want. Good morning, ice cold. Yeah, I'm not getting into that trade. Wait a minute. Yeah. Okay. They don't switch a route on me. Yeah, it's only like $5 extra risk for a difference of like $5 in strike price. That's okay. I guess I'm just gonna have to go for $1 each, risk 150. So an extra like $10 in risk that I'll have to take on. If I can't get it at 105. Thoughts on the VIX? Should we wait for it to go under 10? So the VIX is hard to trade. VXX and UVXY, very hard trades to make just because of their leverage and losing time value. I ended up buying a bunch of VIX. You have to be in and out of it very quickly. Like if you're planning to hold it for a decent period of time, I probably wouldn't recommend. Right? If you're planning to hold it for like a month or like 6 weeks, then not a good idea just because of the time decay that's associated with it. But if you're looking for a short, say 2-3 week trade, I think it would be fine. So if you expect volatility to go up in the next few weeks, that would be a good opportunity. But if you expect it to go up in, say, 6 to 8 weeks, that would be a worse opportunity. Just opened a new target, put credit spread expiring Friday to 3.3 actually at 103 each. Strike prices, we're assuming that it's going to stay above 167.5. All right. So it's right above or right below that 168 level. Again, my assumption, they might beat earnings, miss revenue. But if they miss revenue, beat earnings, it's going to stay above 164. And then finally, if you expect them to miss on both earnings and revenue, they would go below 158 in my best guess. There's exactly a 50-50 split between above 400 and below 400 today. Interesting enough. On VXX, currently trading at 1175. The VIX itself is trading at 20.9. The VIX right now is being kind of artificially suppressed by the zero data expiration options. Not a lot of people are focusing on 30 days out, which is where the VIX gets how it gets its price. So you might not see a decent rally in the VIX unless we have something really crazy going on. So if you're looking at the economic calendar for this week, there's not really much that would trigger the market to go down a lot. Unless one of these reports just comes in way off expectations. And then even if you go out for the next few weeks, I don't think that there's many big reports that are coming out. So we're going to have a probably pretty dry next couple of weeks, maybe even next few weeks. You have durable goods, housing price index we already talked about. Consumer confidence, that could shake out the market in one direction or the other, but it would have to come in significantly better, significantly worse than expectations. For consumer confidence, the Fed wants this to be low. If this comes in a lot higher than expectations, that would be negative for the market. Rates would go up, stocks would go down. And let's see what else we got. Manufacturing PMI. So that's basically the supply chains and how well they're anticipated to be over the next year. Expected at 47.8. If this does improve, that would send the markets up. If this declines even more, say if it comes in at like 45 versus 47.8 expected, that would be pretty significant. That would be bad for our supply chains, which means more inflation to come. Jobless claims. Usually this doesn't move the markets in one direction or the other just because it is pretty accurate. The expectations is 195,000 versus 192,000 last week. But say this does come in significantly different than expectations, if it's plus or minus like 5%, say it comes in at 195 times 95%, if it comes in at 185,000, or if it comes in at 205,000, either that is recession fears if it comes in at 205, or a hot labor market sentiment if it comes in at 185. So this is plus or minus 5%. That would be triggering for the market. For the downside, non-farm productivity, this is basically GDP. Probably going to be pretty accurate, my guess, at 2.6%. The GDP was 2.7% quarter over quarter. So this is probably going to come in likely the same. And then you have PMI. Services PMI is a big one to watch for. If this comes in above what it was at the last report, 50.5, that means more services inflation to come. That would be the big trigger if we do get downside. So you could wait a little bit to buy VIX, VXX, UVXY. Trading options on it would be very difficult, though. I definitely would say avoid like regular call options, even if you have like long expiration date, just because of the time decay again. It is not your friend. Call credit spread for QQQ expiring March 3rd. Let's see. Assuming that it's going to stay below 300, you're still like, what, $5 away from that right now, $4.50 or so. So odds would be in your favor. 300 is a good psychological number to go by. But if all the data is pointing towards, say, disinflation coming out for this week, then we might keep pushing up to that 299.23 mark is the one that I'm looking at right now. So you might end up getting close to your max loss, depending on how the data comes out, right? So if you're expecting the data to come in bad this week, if you're expecting services PMI to come in hotter than expectations, that's going to be the main one. Then that would be a good trade to take on. But if you're expecting it to come in lower than expectations, services PMI to cool off, that would probably send it above 300 in my best guess, maybe just like 302, 304. Yeah, the next Fed meeting isn't until mid-March, March 22nd. But between now and then, you have some big data like Fed Manufacturing Index. That's another supply chain proxy. Retail inventories on March 15th. So you still have a lot of data coming out. You have the PPI. That might actually be big for the market in one direction or the other. And then you have CPI. The next CPI coming out on March 14th. So you're not really getting any inflation data for the next couple of weeks, which is usually the biggest kind of movers. And then you have non-farm payrolls. March 10th, that's usually a pretty big one. JOLTS job openings is pretty big on March 8th, so that would be like a week and a half away. And then you're going to have Fed speakers between now and then too, so they could shift the markets in one direction or the other. Let's see what the current Fed speaker is up to. Looks like we're going back below 399 or 400. That's a pretty significant dip. Dallas Fed Manufacturing Index down 13.5% versus 8.4%, negative 8.4% prior. So that is your supply chain proxy for Dallas, coming in much worse than expectations. So their supply chains are really taking a hit. That would be inflationary. So you're probably going to see the dollar and the 10-year both jumping up on this news. Dollar is at 104.70. The 10-year is currently at 3.926, and that is a pretty significant miss on the manufacturing index. Yeah, no problem. So that could end up triggering us to the downside. That's definitely a pretty fat red candle there, below 50 RSI now. Usually that wouldn't be a big report, but since it came in so much worse than expectations, and negative 13.5 versus negative 8.4, that's pretty significant. I wonder if the markets will shake that off. I'd say that'd be pretty hard to shake off, but let's see. Today's reports. Yeah, so Dallas Fed Manufacturing negative 13.5 versus negative 8.4. If we look at the historical, this has been negative for a very long time, ever since May of 2022. It's just been horribly down. I mean, it's not really that bad, I would say, compared to what it has been since May of last year. So it might be a little bit of an overreaction here with the 400.5 down to 399.5. We are trading below 50 RSI now, so technical analysis geeks are probably going to sell this off. But yeah, the big event that I'm watching is for tomorrow with the retail inventories and then the consumer confidence report at 10 a.m. I think that could hold us back to that 401 level, but we'll have to see. This sell-off might be pretty brutal after that Dallas manufacturing index came in worse than expectations. I wonder if it's worth taking profits on the 391, 390 put credit spread. I doubt that we're going to go all the way down to 391 just based on one report. But with this market, anything is possible, especially with these zero-date expiration options. If people start flooding into puts, then the market makers are going to push the markets down to hedge their positions. But yeah, there was a lot of volume that came in with that Dallas Fed Manufacturing Index. So a lot of people watch that. More volume than we've seen since it opened this morning. At least on the first 5 minutes after the report. And we just got rejected at that 401.44 mark. Pretty clean rejection off of it. Or close to it, I guess. 401.13. Yeah. Inflation's not going down anytime soon. Why would the Fed hesitate to do 50 basis points instead of 3 consecutive? I mean, the Fed, I don't know, it seems pretty intentional with the Fed doing the 25 basis points because we know that the longer that they put it off in raising interest rates, the more pain that we go through in stagflation. And I'm sure that these people that have PhDs know that, but they decide to go with the 25 basis points anyway. And let inflation ride while the growth in the economy slows down to what was the latest GDP report at 2.7%. The odds of 50 basis points is still 24/7, so not really much change. I think it was down to 21% first thing this morning, so a little bit of a rise in the 50 basis point rate hike odds. The dollar index is making the most amount of gains here off of that low 104.50 and some change, 104.54, now 104.72. So if you see this pop back higher into maybe Friday's range, that could be pretty troubling for the market. If it goes above like 104.92 or something like that, that might end up triggering the market back to the downside. Yeah, the Qs really got hit on that one. They were up like 1.1% this morning, and now they're down, or now they're only up 0.9, so that was a 0.2% drop. IWM ended up bottoming, so if this is predicting where the rest of the market's going to go, we might end up bouncing just based on that wick alone. You got that long tail, and then the short body could be bullish to the upside, but watch out for like 189.25 to like 189.13. You're going to get some resistance just because that's the open of the first candle. More people are going to be watching that. Probably going to set some alerts if the dollar index comes back up. Again, I would be watching 104.91, I think, roughly. Create an alert with that. So if we go above that level, then you might see some more downside for the overall market. A 400, 401 call debit spreads are down to 40 when I bought them at 48. And then the put credit spreads that I had, what was the Iron Condor? Those are up by 65, so those have been max profit. I could maybe close them for 1 cent a piece. Not really sure if it's necessary though. If we're trading at $3.99 and I'm assuming it's going to be above $3.91, that's another $8 that we'd have to go down, so like 2%. So odds of SPY dropping 2% in a day would be low unless we have some sort of black swan event for the day. Now the dollar index is peaking 104.73 and headed back down. I think that's really what the markets are paying attention to the most these days, is that dollar index basically trades whatever the inverse of the dollar is doing. If Fed raises 50 basis points, we'll see the market rise. Yes and no. So the problem with saying that is that the March meeting, they're going to do their summary of economic projections, or the SEP, which is going to have a lot more weight to it than what you'll see 25 basis points or 50 basis points. Because at the summary of economic projections, what they do is they give their projections for where interest rates are going to go, where they think unemployment is going to go, and where they think GDP is going to go. So if they're anticipating higher interest rates than they were at the last meeting and higher than what the bond markets expect, right now they're expecting 5.25 to 5.5%, but if the SEP and the Fed projects that it's going to be, say, 5.5 to 5.75, or if they expect it to go 5.75 to 6%, that would be very negative for the market, even if we get 25 basis points. So the summary of economic projections has a lot more weight to it for the March meeting than 25 basis points or 50 basis points. The last 2 times that the summary of economic projections has come out, SPY fell by about 3%. So in September of last year and December of last year, whenever the summary of economic projections came out, SPY fell by about 3%. So that would be the big event to really bet for volatility going up. All right, dollar's pulling back again. Maybe. I don't want that. I want the percent change. There we go. Might have could have held that 399 400 call credit spread. I think we're probably going to end the day up 0.75, probably 0.5 to 0.75% today. So that would be another 0.25% down, probably above 398, but probably below like 400 would be my guess. Probably somewhere in that range. Could even open an Iron Condor with that assumption. Right now we're trading at 40 on the RSI, so you would be betting against direction. If you assume it's going to be between 397 and 401, you get paid 35 cents in credit for a 0 date expiration. That's not too bad. Not too bad at all. I'll be more worried about the 397 strike price than the 401, considering below 50 RSI. They just dropped the bid on me to 33 instead of 35. Oh, there we go. Now they're 35. If they'll give it to me. Doesn't look like it. Yeah, the bid just dropped to 33 instead of 35, so losing its edge for risk reward. Just the put side is paying like 15 cents a credit, which I think is pretty good. Unless you still get a rise out of the dollar. 10 years kind of just neutral. Dollar is pushing up a little bit more. If we go a little bit higher with the call side, say it'll stay below 402, you get paid 25 cents in credit instead of the 33 you get for the 401 strike price. Hard decisions. Yeah, I really think that the Fed is going to have to go with like 6% interest rates or possibly even higher. Just given the recent rebound in inflation, if they continue to, be more dovish, I think that the greatest impact that the Fed has on the markets is with their words. So if they come in more hawkish than what's expected for the summary of economic projections, that would end up cooling off financial conditions. That would tighten financial conditions, which is what they need in order to kill off inflation. Like we saw for January, whenever financial conditions were loosening with everybody buying up every stock on the book, inflation came in hotter than expected. So if you can reverse that, have the interest rates go back up to what we were seeing like in September, October, then that would bring the markets down, which is what the Fed ultimately wants, but they're trying to kind of appease both crowds. They're trying to appease investors while also trying to appease the general population, bringing down inflation back to 2%, but you can't have your cake and eat it too. The problem is you have to go into a recession. A recession is the necessary evil in order to get inflation back down to where we need it. You have to destroy demand or increase supply, and based on what we saw with the Dallas Manufacturing Index coming in way worse than expectations and down since May of last year, our supply chains aren't getting any better, so we have to destroy demand with higher interest rates. So I do think that they could come in at like 5.75 to 6% just to shock the markets. Interest rates would rise a shit ton, which would end up sending SPY back down. I would think that that would probably be an event that would send SPY down to 380 in my best guess, or the next Fibonacci level on the downside. And with that being on the 22nd, that would be below the mother of all trend lines too. I wonder if we're going to fill the gap to the downside. Down to 397 since we gapped up from Friday to today. Really depends on what the dollar and the 10-year does, but we're not getting any really definitive moves as of yet until, again, we go above that 104.91 mark. I wouldn't expect SPY to be below 397. Hence why we got the alert set up. Target still holding up. Zoom is towards the bottom end of today's range. Let's check out those couple of earnings trades that I made this morning. Target down by 2. Zoom down by 12. This is assuming that it's going to stay above 71, which is below the 2-day range. Feel pretty confident in this one unless they end up missing on revenue, missing earnings. That's a 20-day range that it's been into. Above 70.68 at the lowest point. Yeah, it's just looking like a flat day. Unless we get an increase in open interest on calls or puts in one direction or the other, probably just going to end up trading flat. But you got to watch out for those wild swings with the 0-day expiration options. Those have been pretty crazy. I mean, you're seeing swings from 393 to 396 in like an hour here. And then that huge pump at like 3 o'clock from 395 all the way up to 397. It's a huge intraday volatility. Not seeing a lot of volatility like long term though. Like if you look at the, say, the 20-day chart, we're down from 418 to 399 right now. But we were trading just in that wide range of what, like 401 to 420. So basically 400 to 420 for better part of like 3 weeks. See another stimulus check coming in late 2024, mid 2025. God, I hope not. I freaking hope the government doesn't print money like that again. Very nice, Connor. Thank you for your service in inviting more members to the community. Appreciate you for that. I was still the one with the most amount of invites, but I don't get free premium. But I will go and log the trades that I made today over in the drive. SPY put credit spread and the call credit spread. The call credit spread I took the L on, and that's not the right one. But I am going to copy and paste these. Change the dates. Open these on 224. Close them today, 227. 227. They both expire today. My assumption was that SPY would be below 399. So I bought the 400, sold the 399, and then I assumed that the puts would stay above 391, so I bought the 390, sold the 391. I opened 5 of each. The credit that I got was 25 for the call credit spread. Ended up closing at 65, and then the put credit spread I ended up getting 13 cents, and those are going to expire at max profit today. So between those, down 135. And then I opened a couple new ones for Zoom and for Target, TGT. Zoom was a put credit spread, assuming that's going to stay above 71, which is a bullish to neutral strategy. Expiry is this Friday, 3/3. And then Target, I think it was also a put credit spread, assuming that it's going to stay above 157.5, or let's see, double check it, 167.5, which is a bullish neutral strategy. Expiry is 3/3. Strike prices for Zoom were 70 long, 71 short, and then 165 long, 167.5 short for Target. Target I opened 1 for 103. 103. And then for Zoom, let's see, I think I opened 3 of them at $37 each. 0.37. All right. Let me check to see if I made any other trades this morning. I think that's about it. 3 trades this morning. SPY, Zoom, and Target today. Where is my trade tab? There we go. All right, yeah, so the put credit spread for Target, already logged that. Zoom, already logged that. SPY call credit spread that I took the L on, already logged that. And then I opened the call debit spread for SPY, expiring tomorrow. So we'll put that one in. So open this today. SPY call debit. which is a bullish strategy. Expiry is tomorrow, 2/28. Yeah, everything is consolidating and just trading flat at the moment. It shows 400 for the long strike price, 401. I opened, I think, 3 of them at 48. 3 at 48 cents. Let me double check the entry. 400, 401, 3 of them for a total of 144. Or yeah, 48 cents a piece. So that's all the trades I got for this morning. All bullish. Well, I guess the 3 trades that I opened all bullish this morning. SPY, Zoom, and Target. Probably should diversify, but I do have some bearish positions still open from last week with assuming SPY will be below 391 by March 10th, and then let's see, put debit spread assuming SPY will be below 395 on March 24th after the Fed meeting. I think that one's pretty much in the bag, but trading at 400 right now definitely decreased the value from what it was trading at last week. It was trading at 43. Now it's trading at 28 or 38. Kind of want to go deeper on it, but this is a debit spread, and I don't usually like to spend a lot on debit spreads, so maybe with a longer expiration date, it's worth it. I'm not sure. Definitely got it at a way better price than what it's trading at now, though. These are up 30%, so guess we'll just leave it be for now. Yeah, no problem, Peter. And I will catch y'all tomorrow, Tuesday at 9:30. See you, everybody.